Commercial lending is an example of uses of fund, and it has many items. One of these items is considered term loan, which means a corporate will get a loan from a bank. Consequently, when we talk about the term loan, we need to discuss what will be the period of the loan. And when we talk about the period of the loan, this means that for each bank, they need to look at the maturity match, which means they need to discuss their asset items, their liability items. Consequently, they need to make a match between asset and liability items. Consequently, if they have a deposit for 5 years, this means that they should give a loan for around 5 years. They cannot have a deposit of 1 year and then give a loan for 10 years. This would result in maturity mismatch. Therefore, all the time, our target will be maturity match. Second one we need to consider is the type of interest rate. And we have two types of interest rates. Either fixed exchange rate, fixed interest rate, or floating interest rate, which means it depends on the market. Usually, you cannot have a fixed interest rate for a very long term. It will be for a year to a maximum 5 years. You cannot have it more than 5 years because it will be hard to predict what will happen afterwards. Then what we need to take into account is the repayment or the loan type. When we talk about the loan type, we have either amortized loan, and amortized loan, it means that every period you pay interest and part of the loan, which is called principal. The other one is called interest only, which means every period you pay only the interest, and at maturity you will pay the whole loan. Then the collateral. We have secured loans and unsecured. Secured loans, it means that we have collateral. Unsecured loans, it means that we don't have a collateral, which means a company might go to a bank and they will tell them, I would like to get a loan of $10 million because I will buy this land. I cannot sell the land before I pay you. So this means that we have a collateral. That's why it's called secured loan. Consequently, the level of risk will be higher, interest rate would be lower. But another company might go to the bank and just get a loan of $100 million or $10 million without any collateral, without any fixed asset for them. Therefore, this is considered unsecured loan, which means it has a higher risk. Consequently, interest rate will be higher.